Hey, good morning. Welcome back, everybody. So, the question for today is the gold market confusing? I got an article here I found very interesting I want to share with you. Let's talk about this confusing gold market when we return. Hey, everyone. Welcome back. I'm the Florida Stacker. And if you're new here to the channel, well, I like to purchase gold and silver coins, bars, and rounds. I like to hold them as my physical savings account, as a savings account outside of the financial system. And the reason I'm doing this is if you've been paying attention to the economics going on in the world now for some time, you know that all fiat currencies are debasing and devaluing. All right. So gold and silver, they're natural hedges to inflation. We're seeing some inflation in the market right now, but beyond all that, purchasing gold and silver is the most fun and engaging way to save. The reason I say that is because you actually get to make a purchase that you can hold. And there are many different designs out there. So it's kind of a way to both collect and invest in your future at the same time by maintaining your wealth in gold and silver. All right, so as mentioned, I'm the Florida Stacker and I love gold and silver. In today's video, we're going to talk about gold price analysis and why sometimes the gold market can be so confusing. So I've got an article here from capital.com. I think this is a pretty good article. It's got a lot of great information in it. So let's get started. All right. So if investors were required to pick one word that accurately sums up the gold analysis, it would certainly be confusing. The gold chart analysis since 2018 shows clear momentum from its lows of 1,176.70. Ooh, that'd be a nice spot price for today. After which a long-term uptrend ensued and then pushed gold to a trade at historic highs just below $2,100 in the summer of 2020. So we went from 1,176.70 in 2018 to almost 2,100 in the summer of 2020. That's a pretty good bull run right there. Right now, we're hanging out at about 1725. So we've definitely pulled back, but still maintaining quite a bit of those gains. Okay, so continuing on. Since peaking in the summer months, gold has lost momentum and has shown no willingness of retesting its highs. The weakness goes against what many investors had expected to happen. Gold entered the near year with a major catalyst for growth. The higher gold price prediction was based on President Joe Biden's massive $1.9 trillion stimulus package that by default bodes well for the metal. So if gold is a natural hedge to inflation, we're increasing the money supply and we're seeing inflation, then you would think that gold price should be way up. So what can we expect in the coming weeks and months? Will gold prices go up in March 2021 or will the sluggish trading activity continue? That is the question. So is the gold party over? Well, gold and other metals like silver ended 2020 with their strongest gains in a decade, and for good reason. Some of the more notable factors that supported a higher gold price forecast include the weakening US dollar, continued uncertainty created by the COVID-19 pandemic, and, of course, expectations for rising interest rates. None of these catalysts have abated since the start of 2021. Quite the contrary is true, as all of the factors that supported a higher gold price change remain in place. And that's what I keep talking about. The long-term aspect, the long-term view for gold and silver is extremely positive. However, it would be reasonable to conclude that the exciting trading action seen in 2020 has not come to an end and that 2021 could just be more of the same. Maybe we'll see new highs. Meanwhile, the global vaccine rollout against the COVID-19 pandemic continues with few, if any, major setbacks. As each day passes, millions of new people worldwide do receive the vaccine. Yet, after 2 full months of trading in 2021, investor enthusiasm for gold appears to have faded, and investors are riding the trend in other hot catalysts like copper, platinum, palladium. Those are 3 metals that are doing what gold is not doing, and that is moving higher with signs of momentum, signs that is. Also important to note, the US dollar's recovery stalled throughout February and many markets gained against that weakness. Surprising to many, gold wasn't part of that rally despite the historical inverse relationship that the dollar and gold possess. The euro and British pound, on the other hand, took advantage of the US dollar's weakness. All right, so let's talk about more analysis here. Gold price analysis, don't count on inflation to support the metal. I think we're seeing that, right? There is no mistaking the fact that gold prices historically perform well during periods of inflation, but the inflation outlook for 2021 isn't supportive of the upside case for gold prices. Current projections worldwide for inflation are relatively tame. However, some of the more recent projections estimate the inflation rate will begin to pick up in 2021, around about 2.2% versus 1.4% across all of 2020. While this would represent a year-over-year uptick, it is down from 2019's level of inflation, which was 2.3%. Now, I don't necessarily agree with this forecast. I think there's quite a bit more inflation in the market right now than the government is willing to report. All right, moving on. So the Bank of England's February 2021 report reaffirms a 2% inflation target rate. That's the same for our Fed. Even if the inflation picks up in 2022 and beyond, the near-term prospectus, it's not very supportive for gold on the upside. So what this article is trying to say is that historically, a lot of people look to gold as a hedge against inflation. However, I think what this article hasn't mentioned yet is that the rising yields have more than counterbalanced that natural catalyst for gold value to increase during a time when we see inflation. I think we're seeing inflation. It's just those yields have really put a cap on gold's ability to rise. Okay, so how to buy gold? Well, you know how I like to buy gold, but investors do have several options at their disposal if they want to gain exposure to gold. The first is through buying physical gold bars or coins and storing them at your home or in a bank's deposit box. Okay, I don't recommend you store them at a bank deposit box. What's the point? If you're going to buy physical gold and not actually have possession of it, wouldn't it make more sense to keep it in an account that you can be much more liquid? This is just my opinion, of course. If I'm not going to hold it in my actual hands, then it's going to be in some type of digital account where I can move in and out to increase my fiat holdings so that I can actually buy more physical gold. All right, the second way is to purchase through a gold exchange traded fund or ETF that offers pure exposure to the physical commodity, such as the Spider Gold Trust on the New York Stock Exchange. You can see the ticker GLD. The third way is through investing in a gold mining company. We do have a new precious metals mining and royalty series that's kicking off. I'll be dropping 2 videos on that today. An example of investing in gold mining companies is investing in something like Barrick Gold Corp that, of course, Warren Buffett invested in last year. That is ticker symbol GOLD or gold. And fourth, investors can buy a basket of gold mining companies through an ETF like the VanEck Vectors Gold Miners ETF, which is stock ticker GDX. There is a fifth way, and that is the OneGold way of doing things, where you can both invest in the physical asset digitally, right? So we've got it's digital on your screen, but it's all backed by physical big bullion bars in massive vaults scattered across the world, where you can also make cash deposits and purchase bullion products directly from Apmex. So I'm going to go ahead and throw that as the fifth way. Regardless of investor preference, we have seen a lot of outflows from ETFs in the recent weeks. There is no one method that is superior to the other. I think physical accumulation is superior here, and investors can evaluate which option best suits their investment needs. Key levels to consider as a contrarian trade. All right, so a key part of the gold price technical analysis is to identify resistance and support levels that were evident to start March. We were seeing resistance in the high 1600s for gold, and actually that's support in the high 1600s, so like 1685. We were seeing some support levels, and resistance is currently around the 1725 to 1735 level. Taking a look at the gold chart points to the following 3 support and resistance levels for gold. Okay, so I gave you my numbers. Let's see what the article says. So resistance from February 10th high was 1855. January 21st high was 1875, and going back to November 9th, the resistance was 1965. Support levels on February 19th, 1760. On June 15th last year were 1703, and some of our lows that we've experienced recently, 1670 on the recent lows. At the time of writing, which is March 9th, gold already fell below the first 2 support levels and was trading just below 1700 an ounce. Slightly up from that now. Gold's near-term momentum is clearly pointing to the downside, so buying gold in March would be a contrarian play. Okay, I like to look at the 3 metals, gold, silver, and platinum, and I like to find the undervalued metal. And right now that's going to be gold. If you look at its performance over the last 6 months, gold is the one that has trailed off the most, whereas silver has really held its gains from 2020, and platinum is starting to creep higher and higher. The relative strength index has dipped into the oversold category 4 times now since late November on gold, and the recent weakness hasn't changed on the technical tools. So what's the bottom line here? Okay, there's 2 trends and we need to pick one. The classic saying is the trend is your friend. That will never disappoint, but there are 2 trends to pick out. On one hand, the multi-month trend since gold's peak last summer is weak, and the price of gold showed no signs of rebounding after hitting the first 2 support levels. The same can also be said for the price of gold since entering 2021. The metal traded just shy of $1,900 an ounce on the first day of the year and has peaked during 2020 right on that opening, just shy of $2,000 an ounce. However, the multi-week chart shows the same pattern as it does the multi-month chart, and that is that gold has failed to sustain any momentum and continues to drift to the downside. But on the other hand, gold is showing multi-year strength dating back to mid-2018, so when you expand the horizon out, gold is definitely still looking strong. The longer-term trend is showing some signs of weakness, but it does remain intact. The next major price that could determine if the multi-year long trend remains intact is that $1,500 support level. I don't think we're going to get to that point ever again. And that corresponds to March 2020 lows when we were back at 1,500. A break below 1,500 might serve as a reason to believe that the gold party has indeed come to an end. I can tell you what, if gold does break to 1,500 on the spot price, I will be buying a lot of gold. Will the gold price rise? Okay, so keep in mind that with contracts for difference, you can capitalize on any gold price movement. Open a long position if you predict the price will go up. That's what I'm doing by steady state accumulating physical, tangible precious metals, or open a short position if you would expect it to go down. I'm not going to be doing that. That's when you could go in and you can actually sell some of these stocks and then purchase them back if they fall and net the difference in profit. You can track the gold spot price in real time on our interactive chart. I like using JM Bullion or Apmex's tool. All right, so that's going to conclude the article. So some thoughts here. Personally, I think that going long on gold is the great way to go. I don't look at gold and silver as quick plays. I think you can make a lot more in fiat currency by playing the stock market or by investing in cryptocurrency. Gold and silver is not where I would recommend you park your assets if you're looking to get in and get out quick. Okay, it's not going to the moon. I hate to shatter your dreams here, but silver, there are just too many forces at work to hold the price of silver down. I do not foresee silver staying in the $20 to $30 range much longer. I think we will see over $30 silver during 2021. But as mentioned, you can make money a lot quicker in other asset classes. Gold and silver is protection. It's a safe harbor. It's also a very fun and engaging way to build by converting your paycheck money into tangible savings. So you're sort of building your wealth by making those purchases, but really what you're doing is you're maintaining your wealth with some upside potential, especially over the long range. All right, everybody, I hope you enjoyed today's video. Gold can be confusing, but in my opinion, and once more, I'm not a financial advisor. I'm just a guy on YouTube who likes to buy gold and silver and talk about it. I do think the long-term outlook remains extremely bright. And if we do see a dip back in spot price, well, that's just another buying opportunity. Thanks again, everyone. We'll see you soon on another video. Have a great day. Stay safe. Take care, my friends.